I don't know, David, did you ever think that the dollar would be the same as toilet paper, as that guy on CNBC said there?
Well, I happen to follow Peter Schiff pretty closely, not because I agree with him, because I completely disagree with him. He's what you call a gold bug, a perma bear, all kinds of names, but he's been completely wrong. The dollar surged 17% over the last year, which to really high levels. And you know what it means is, and the reason that's happened is because we are actually increasing interest rates. The rest of the world, Europe, other parts of the world are decreasing interest rates, so it makes people attracted to our dollar. The benefit to the consumer has been lower oil prices, which has affected you at the pump. You've seen significantly reduced gas prices, which will ultimately help the consumer. On the negative side, it's really hurt commodities. So if you own gold, you've lost about 8% over the last 30 days, and we're still 35% off the highs. So I know when your listeners asked me one time, Craig, you know, what do you think about gold as a safe haven? I said, well, not for me. And,
well, you're seeing a lot of gold advertisements now. You see them in the paper. They're all over TV, and it's. I think the message is fight inflation here, buy gold. So we shouldn't buy into the commercials?
No, I mean, you know, I've studied gold, and, you know, they say it's an inflation hedge. It's really gold, its own currency. It's really a fear currency. So the thing that bothers me is, even though you've seen the problems we've had in Russia and Ukraine, typically you would see a flight to that type of asset class, and you've not seen that. In fact, gold, as I said, has dropped 8.5% in the face of that. So I've studied gold, like I said, you know, is it an inflation hedge? Sometimes it is, sometimes it isn't. It's really more of a fear currency. Right now, the main focus is still on the Fed. They're going to end their bond buying in October. They're talking about raising interest rates in 2015, either the spring or the summer. We're already seeing the effects of this, though. Rates have climbed, you know, not significantly, but to give you an idea, you know, real estate investment trusts, which are tied to interest rates, are down 5% for the week. Bonds, long-term bonds, treasury bonds are down 5%. So anything that has an interest rate tenor to it has been hurt. So the internals are a lot more worse off than you see the overall market right now.
Have you ever heard the expression whiff 'em?
I have. What's in it for me?
What's in it for me? Why should I care? So you're talking about gold declining, bonds actually have gone down, mortgage rates have gone up a bit, but I'm watching this show. I know David Reyes is one of the wisest financial advisors here in San Diego. What's in it for me? What can I do about it?
Well, I always say, you know, reevaluate where you're at. Right now is a great time to do that because, you know, we are near all-time highs. We're at a very big inflection point in the market. The Russell 2000 is really negative this year, which is small company stocks. You know, the rest of the market's up in the low single digits. So it's a time to really look at your bond portfolio right now, your stock portfolio, and make sure you have the proper allocation and real risk management for your portfolios. That's my big advice.
You know, I think what's really interesting about that, David, is that typically when you talk about bonds, you're talking about a safer investment. I remember when I was meeting at your office, there was we'll just say another advisor that had allocated someone 60 to 40 stocks versus bonds. It was very cookie cutter type of plan, and you didn't like the plan a whole lot. You thought there was a lot of risk in it?
Yeah, because all you're doing right now, see, unfortunately, most Americans have not been through a bond bear market. They've been through stock bear markets, but not bond bear markets. The last time we were at low interest rates like this was the 50s, and from 1950 to 1980, on an inflation-adjusted basis, bonds dropped 40%. So all you're really doing is transferring risk from stocks to bonds by increasing your bond portfolio. So even in the financial crisis of 2008, if you had a 60% stock, 40% bond portfolio, you still lost 30%. That's not risk management. So, you know, at our firm, we really are pretty serious about risk management, and those drawdowns are just not acceptable for our clients.
Well, David, you offer a review to anybody who watches the show. You're on our radio show on KCBQ throughout the week, and when you do these reviews for our listeners, our viewers here today, what are some of the things that you find in them? I know we've talked about, you know, how well diversified you are you hedged against inflation? What are some of the biggest mistakes you think people have? What are the ticking time bombs?
Number one, taxes. Everybody overpays taxes. There's not a client I sit down with that I cannot help reduce taxes. That's number one. Number two, I would say maximizing Social Security for pre-retirees and post-retirees. Those are two of the main issues that we look at. And then obviously we have a different approach with risk management. We deal with what's called like absolute return investing, where we don't want to lose any money if we can. There's an old saying that if you only get 30% of the upside of the market, which is a fact, and you don't have any drawdown or losses, you actually beat the market. So we want to focus on defense, as you know, Craig. So that's our philosophy, and we want to make sure that we control the things we can in taxes we can control. And I know you work with one of our other elite, and Mr. Jennings does a great job. And it's another thing that we focus on for our clients as well, as taxes and things that we can control.
David, awesome information today. I want to give a really important takeaway to people that are watching right now. The market's going to go up, down, left, right. There's going to be politics. There's going to be things that Janet Yellen does. There's going to be all these different policies, a lot of noise that happens around all of it. When you talk about something like taxes, as David just mentioned there, it doesn't matter what the market does. It always makes sense to try and reduce your tax liability. Do it ethically. Do it within however the law is written. I'm not the tax guy. Doug Jennings is. David is. But if the market goes down or up, if you can reduce your tax liability, you're always improving your financial situation. So I really, really encourage you to use that as your takeaway today. David Reyes will do a financial review for you. Typically, advisors charge thousands of dollars for something like this. As a viewer of the show today, if you visit him online, go there right on your smartphone if you like, and you send him a message. He's going to do this for you for free. He'll look for things like how well diversified you are. He'll look for things like, are you going to get taxed when you pull these investments out? Are you hedged against inflation? Are you in the proper tax bracket? Are you structured properly? These things are so important for you no matter what the market does. So I really, really encourage you. Visit him at reyesplan.com. David, great information today with the Reyes Report. Thank you.